In this presentation, we will calculate a problem related to composite units. Composite units having to do with a situation where we have more than one product. You might be asking as we go through this analysis, well, what would happen if we have more than one product, which is often the case? Well, it gets more complex fairly quickly. We'll go through a system that we can use and some assumptions we need in order to use this system here with the use of composite units. We're starting off a new worksheet. We're going to do this a bit faster with the formatting, so I'm not going to go into the formatting as much. We will have a pre-formatted worksheet as well if you would like to use that instead. So we're going to set up composite units, and we're going to highlight that. I'm going to go to the Home tab, and let's make this in the Styles group and make it a title, or the Styles and Cell Styles. I'm going to make this a bit larger. We're going to go back up to 140 here. And once again, I'm just going to take the data and put that up top on the worksheet. If the data is in a book problem or in real life, what you want is the data up top so that you can make reference to the data and then be able to change it as easily as possible. That's the point of the CVP type of analysis. You want to make a worksheet that you can manipulate around as the data changes, because these are all just estimates. We're just kind of thinking what could happen next year, and this is the best way we can make those estimates. So we have products A, B, and C in this ratio. Now note what they're giving us here, a ratio of 3:4:3:3. Now anytime we see that, you want to be able to look at that and say, well, what does that mean? What does it mean to have this type of ratio? And then I would break that down into a format that makes sense for us as we enter this into our worksheet. And the way that makes sense to me is to type this out. I'm going to say, all right, we have product A, product B, and product C. These are going to be the three products that we have. And I'm going to move this down. I'm going to highlight these. Let's move that down, give us a little bit of room. And we're going to say that there's a ratio. This is, in essence, a ratio. This is a 4:3:3 ratio. That means it's going to apply first to A, which is 4, then 3, then 3. If I was to sum that up then, if we were to add these up, 4 plus 3 plus 3, I'm just going to sum up 4 plus 3 plus 3, and that gives us 10. Now we're going to take a ratio analysis of this. We're just going to say 4 divided by 10, 3 divided by 10, and so on. So this equals 4 over 10, and that's going to give us 0.4, or if we make this into a percentage, we would then say that it's going to be 40%. That if we took 3 divided by 10, we got 30 or 0.3 or 30%. And then of course 3 once again divided by 10 will also give us 0.3 or 30%. And if we sum that up, then we'll get our 100%. Now you might be asking, now before we get too much further, I'm going to highlight the whole worksheet, right click on it, format the cells. I'm going to make it currency first, and then brackets, I'm going to remove the decimals as the default, and then we'll add them where necessary. Okay. And then I'm going to reformat these cells because I just messed them up. Home tab, and then percentages. Okay, and then I'm going to highlight the whole thing. I'll make it bold. Maybe make it easier to see. So note, you might say, well, why don't they just tell us it's 40:30:30 instead of 4:3:3? And note that it doesn't always work out that it's perfect because a ratio might not be even. So this format is going to be working in more situations than this type of format. But in essence, here we have a 40:30:30 kind of ratio between products A, B, and C. And this is where the ratio we're going to assume that we produce these things in essence. So when we think about the three products, we produce them in the format of 40:30:30 to have our 100%. We need this kind of relationship so that we can do our analysis. So we need to have this type of ratio. This is one of the assumptions that has to be there in order for us to move forward. So I'm going to go ahead and format that a bit. So then the next items that we're going to need up top in our data is going to be that the fixed costs are going to be this 19,575. That's the other piece of data that's given for us. They're also going to give us the price and the variable cost. I'm going to put that up top in our table here for A, B, and C. So I'm going to say price and variable cost. Variable cost. And this one I'm going to wrap the cell this time. So I'm going to go ahead and go to the Home tab, Alignment, and let's wrap this one and then center it. And so we're going to say the price is 44, 119, 269. And then the variable costs at 27, 72, and 97. Now I'll format that. I'll continue with our table. So there we have our information. We can make this black and white if we'd like to. As we move forward, we're going to rebuild this table a little bit. And you might think, well, why are we doing this twice? Why didn't I just start off building what I would need to build? We want to have the data set up top. I want to be able to change this data set and have it change everything else. So I'm going to basically rebuild this table in a bit down here, but I want to be able to change the stuff in the data set and have it change everything in our table for us. So now we're going to have the price per composite unit. And this is going to be like one price as if we sell one product. That's what we're going to try to do. We're going to take our 3 products and have basically the price per one unit, the price per composite unit, as if we like put them all together. So I'm going to put this table together and I'm going to build it as we go and kind of manipulate it as we go so you can see how we might do this in Excel. So we're going to say this is going to be the price per composite unit. And so first of all, I'm going to make this a little bit larger so that we can have this information here. We're going to pick up our units, A, B, and C. I could do this with a formula. This equals A. And then you could autofill it down. Notice it's going to fill the relative references, autofill, to get the B and the C. It's just a formula. And then I'm going to have the price per composite unit. I'm just going to copy this and put it down here. That's what we're going to end up with. And then we're going to have the ratio, same items that we have up top. We're going to start with the ratio, and then we're going to have the price. So these 2 items, we're basically duplicating our table here. The ratio is going to be the 4. And then I'm going to autofill that down for 3, 3. You don't want to hard code these. You want the formulas because you want to be able to change the formula up top if you feel like it and see what the difference will be in our calculation. Price, we're going to say this equals the price, which is this item. And then again, I'm going to populate this down. That's going to be our price. And then we're going to say this is going to be the total per composite unit. Notice this is going to happen all the time when you make these tables. You're going to say, oh man, that's not going to fit. Total per composite unit. Way too long. What do I do? Well, we could wrap it. The easy thing to do is go to the Home tab, Alignment, and wrap it. So it does that. And that's not a problem if there's nothing over here. You're good with that. You can widen this cell out if you need to. Right, we can make this a little bit wider to fit what we need. I like to highlight all 4 of them to make it wide enough to fit what we need and make them all, the same size. If I misspell things, I apologize. And so we could then center these items, and there we have it. So now we're going to multiply this out. Now this looks funny. You might say, well, why would I take this kind of ratio number and multiply it times the price? And once again, this is kind of a ratio analysis to us to put together the price of a unit as if it was all one unit. So we're using a ratio analysis type here. So the 4 times the 44 gives us the 176 for product A. The 3 times the 119 gives us 357. And then the 3 times the 269 gives us the 807. And then if we highlight or sum all those up, we're going to say that this composite unit, this kind of manipulation of us just blending together these totally random different products that may be totally randomly different, and adding them together, we have a composite unit that would be at a cost of 1,340. So this is kind of just like an average unit that kind of combines all the units together. And now that we have that, we could do our same kind of analysis on it as if it was kind of one product. We basically combine this into one freakish product that's all one with this $1 amount, and we could do our similar type of calculations with it now, which is, of course, the goal. So we can then format this a bit if we so choose, which we do. So we're going to put some brackets around it and do some fancy smancy stuff. All right, and then the next item that we're going to have, that's going to be the price. We need to do the same thing for the variable costs because the calculation we're going for is, of course, the contribution margin price, composite price calculated. Now we need the composite variable cost per composite unit. Similar type of calculation here. We're going to say the variable cost, this is what we're doing, per composite unit. variable cost per composite unit. I'll make this a little bit larger so it can fit that out. Once again, I'm going to take this information from the table up top for A, B, and C. So A, B, C, auto fill in down. I'm going to copy this item. That's going to be down below. And then we're going to have our ratio once again. Ratio is going to be equal to our data up top. You don't want to hard code it. You don't want to just type it in there. You want the formulas. We want formulas whenever possible. We put the formulas in whenever possible. And then we're going to have the variable cost per unit. So this is going to be a long one again. It's not going to fit. It's not going to fit at all. I'm not even worried about it though, because I'm going to type it in there, enter, and then we're going to go to the home tab, alignment, wrap the text, and we're good. And then this is going to be the total per composite unit. Notice if your header labels aren't perfect and you're just kind of working a problem, that you need to understand the concept, not the labels. If you use a different label or shorten the label or use some kind of abbreviation for the labels, that's okay. And so we're going to highlight, if you're going to give it to somebody else, then you need to make it whatever they want it to look like. So then we have that, and then we're going to say that the variable costs are going to be these items, 27, 72, and 79. So I'll pick that item up, then we'll auto-fill that down. Auto drives it down. Dr. Phil does the calculations. That's why it's auto-fill, or what I like to say for the reason, I don't know why they actually call it. Anyway, and then we're going to multiply the 4 times the 27 in a similar fashion as we did up top with the price, now with the variable costs. And we're going to do the same with the 3 times the 72. Could we auto-fill this down? We could, but I'm not going to because I want to emphasize the calculation here. And now we're going to have our composite variable cost. Again, kind of freakishly putting these 3 products, A, B, and C together and seeing as if it was one kind of crazy composite unit, what would be the variable cost. And there we have it. It would be $6.15, of course. And so then if we highlight this, we're going to make it blue. We're going to put our brackets in there. Now we've got our price for this freakishly ABC unit and our cost for it as we kind of conglomerated this together. Now we can do our calculation with it. And of course, our calculation is going to be the contribution margin for the composite unit, which is going to be kind of like our CVP analysis, the top of the contribution margin income statement, price minus the variable cost. So we're going to say, okay, this is going to be equal to the price per composite unit minus the variable cost, the 2 numbers that we just figured out. That's nice. So we're going to say the price is going to be this item and the cost for our composite unit is that item, and therefore our contribution margin, I'm going to copy this and put that down there, is going to be that. And if we subtract these out, then we're going to say that there's going to be our contribution margin. So I'm going to underline this. I'm going to, possibly double underline that. Notice you can do all the other kind of fancy stuff here that we wanted to do it. To do with this, you can figure out the ratio, contribution margin ratio, which would be this item divided by this. Let's just go ahead and do that. It would be this divided by this. And then we would make that a percentage. The variable cost would be this divided by this. So we've seen these calculations before. This divided by itself would be that, and these are all percentages. So there we have that, and that would be our percent. So we can do all the same stuff we did before, but now in the format of this composite unit that we have generated. So once we have that number, the next standard CVP type thing is to calculate, well, what would be the break-even point if we had this one composite type unit thing? Good question. Let's do the calculation. That's why we're here. That's why we did this weirdness. And we're going to say that this is going to be the fixed costs. Now that's going to be the given fixed costs. We're going to divide that by the contribution margin per unit of this composite unit now, which we just calculated at the 725. And so this is the fixed costs, the ones that don't change, like the rent. And this is like a conglomerate of the composite units in the contribution margin of it, and therefore we're going to say this is the 19,575 divided by the 725, and that's going to be our break-even point in units. So there we have that. Again, we can make that blue. We can put the brackets around it. We can make this, black and white if we so choose. Now, we know that we're going to sell 27 units. If we multiply that times our composite sales price, which is our composite sales price up top, we said was the 1,340, then we're going to say, well, these 27 units that represent like a conglomerate, if we sold them all at this sales price of 1,340, then we would get the break even in dollars of the 36,180. Remember, we could do that same kind of break even analysis in dollars. We have two ways we could do the break even analysis in dollars. We can calculate it in this format, or we can take the fixed costs divided by the contribution margin ratio, which in this case is the 54. That's going to give us the same number. This is the break even point in dollars now. So I've gone ahead and formatted that for us now. But that's not the interesting point here, because notice we're not going to sell anything for 1,340. That's basically just the composite sales price. We're actually selling these for the amounts that are given here, the 44 and the 119 and the 269. So how is this going to actually look when we actually think about the income statement from a contribution margin type income statement? So once we break this out, it'll give us an idea, and hopefully this will all kind of pull together and make sense in this final step. So we'll calculate the number of units of each product to be sold at the break-even point. So notice we've got this composite units. How much of each product are we going to sell? That's what we're going to calculate now. I'm going to wrap this so it fits there. And to do this, we're going to have the products. Let's put the products in there first. Once again, A, B, and C. And then I'm going to autofill down. I'm using formulas to do this. I'm not just typing it in there. And then we're going to have the total. And the next item we need is going to be, I'm going to call it the number per composite units. Composite unit. And this is basically the ratio that we have, which was the 4. So it's the 433. Again, I'm using formulas to do it. I'm going to wrap the text here. So we're going to go to Home tab, alignment, wrap the text. I'm going to center the text for this one. And then we're going to have the number, let's say the number of composite units to break even. So this is the number of composite units, all of them combined together. Again, Home tab, alignment, wrapping the text, and here. And so that's going to be the number we calculated up top, which was 27. These are the composite units, which again, now we're breaking out in accordance with, in essence, the ratio now. So 27 all the way down. And this is going to be then the unit sales at break even. Forgot the N. So we'll wrap this. I'm going to format paint this one and multiply this out. So the 4 times the 27. I'm going to copy this down this time. So notice again, we got the composite unit, which were basically 27 units, which we're just breaking out in accordance with the ratio now, which in essence, you could say this is, as we saw up top, 40%, 30, 30. So that's basically what this is saying, 433. We kind of did a ratio type of analysis on the 27, the way we formatted this out. So now we've got the 108, the 81, and the 81 are going to be the actual units in accordance with our ratio. And if we sum this up then, that's going to give us our 270, which of course is the 27 times 10 in a similar type of ratio type of breakout. In other words, if we took this 81 over the 270, 81 over the 270, and the 108 over the 270, and broke that out into our percentages, we get that same 40, 30, 30, breaking this out back out into our ratios. So if we highlight this, we'll format this a bit, we'll put some brackets around this, and we'll do one more step to kind of pull this all together, and that's going to be an income statement. So we'll take a look at an income statement, put this information into it to see how it might look. This is going to be our test. Notice this is our test break even. So we're going to test this out and say, this is what if we put this into a contribution margin income statement? What would it look like? And would it come out to 0? The net profit should be 0 because this is a break even type of analysis. So we'll have our same kind of structure, which will start with the sales, but now we're going to break out the sales between A, B, and C. So I'm going to say sales for, I'm going to pull them from here now, A, B, and C. I'm going to highlight those out. Then we're going to put up top, we're going to say units. So we're going to pull out the units, and then the units are what we calculated over here is the 108. That's what we just calculated, the 108. And then I'm going to autofill that down for the 81 and the 81. And then we're going to have the sales price. So sales price, that's given to us in the data. So I'm going to say all the way up top, we said the price was 44, 119, and 269. So I'm going to pull that information. So the prices. And then if we multiply that out, then this equals to 108 times the 44, and autofill that down. That's going to be our totals, and we'll have the amount here. And so if we sum that up, then we're going to say sum, whoop, and that's going to give us our total sales. Now we might want to make this a little bit fancy. I'm going to highlight these. Home tab, alignment, increase the indenting, and indent this one a bit more, just so you got that kind of indentation. We can say sales, colon, something like that if we'd like to. And then we're going to have the variable costs. And same thing, I'll put a colon here, and then we want A, B, and C. So we'll say A, B, and C on the variable costs. And the variable costs are going to be equal to, that's going to be the same units that we have, the 108. Whoop, picked up the wrong units. We'll pick them up from here. This one down to the 81. And then we've got the variable costs per unit. So I'll scroll back up and we'll say the variable cost per unit is the 27 in our data, the 72 and the 97. So I'll highlight these two, these items. Let's just call this per unit items. And then if we multiply this out, this is going to be the 108 times the 27. Going to autofill that down. I'm going to underline this item. We'll underline this item, then we'll sum this up. And that'll be our total variable costs. We can then format this. I'm going to indent this. I'm going to indent this. We can do some formatting there. And that'll give us our contribution margin. So we're going to say the contribution margin then is going to be the sales minus the variable costs. And then we're going to have the fixed costs, which should be the same number because we just we're testing the break even in our data 19,575. It's the same number to give us the net profit. And so we're going to say this equals this item minus this, and there's our net profit. So this is testing the break even. So you can see what we did. We basically we put everything in as if it was a composite type of unit, so we can think of our same numbers in a composite format, and then we broke that unit back out so that we have our sales. In order to do that, we need the standard kind of ratio between them, the 40, 30, 30, the 4, 3, 3, so that we can break this information out. I'll go ahead and format this now. I'm just going to highlight this. We'll make it blue. We'll put the grid lines in. We'll put the black and white up top. We'll center these items. And this probably should have a double underline down here and maybe an underline here. So just some formatting that we could use. We might want a underline there.